All right, welcome. Today, we are going to get right into the heart of what moves the markets and, your money. We're talking about the big two, the bulls and the bears. What really drives them? How can you learn to spot them? And, probably the most important question, how do you navigate the world they create? Let's get into it. Before we even look at a single stock chart, let's start with something much simpler. Peaches. This quote is just a brilliant way to break down the engine of any market. So picture it. You've got tons of people who want peaches. That's huge demand. But there's only one seller. Well, that seller can pretty much name their price, right? That's what we call a seller's market. Okay, now flip it completely. Imagine tons of peach stands, but only a handful of buyers. The sellers have to drop their prices just to make a sale. And that's a buyer's market. Believe it or not, the stock market, with all its crazy complexity, boils down to that exact same principle.
So, let's take that simple idea of the peach vendor and bring it over to the world of finance. This is where we swap out terms like buyer's market and seller's market for something a little more animalistic.
When the buyers are in charge, feeling optimistic and outnumbering the sellers, they push prices up, up, up. We call that a bull market. And the image is perfect, right? A bull thrusts its horns up. On the flip side, when fear takes over and the sellers are in control, they start dumping stocks, pushing prices down. And we call that a bear market. The image to hold in your head here is a bear swiping its massive claws down. It's simple, it's visual, and it's a really great way to remember which way is which.
Okay, that's the theory. But how do you know which one we're in right now? We can't just go with a gut feeling. We need to look for actual evidence, for the footprints that price movements leave behind. And that is the entire job of what we call technical analysis. It's about learning to read the story the market is telling us, right there on the charts.
Now, this slide here is probably the most important technical definition we're going to talk about. It is the literal blueprint of a trend. Let's think about a bull market, an uptrend, like you're climbing a mountain. You climb for a bit, make a new peak, then you come down a little to rest in a valley. Then you climb again, past your old peak, to a new, higher one. That's a series of higher highs, the peaks, and higher lows, the valleys. It's that beautiful, consistent upward progress. A bear market? It's the exact opposite. It's like you're climbing back down the mountain, making a series of lower peaks and lower valleys.
This is so important. Before you ever look at a single individual stock, you absolutely have to know which way the main tide is flowing. This quote captures it perfectly. It's why all the pros start by looking at the big market indexes, the S&P 500 or the NASDAQ. Because if the whole market is in a powerful uptrend, it's just much easier for individual stocks to do well. Trying to find a stock that's going up in a horrible bear market? It's like trying to paddle a canoe up a raging river. It's not impossible, but man, you're making your life way harder than it needs to be.
So, if the chart is a story, how do we actually read it? Well, analysts have a whole toolkit for this. They start by looking at the tiny details, the individual candlestick patterns. You can think of these like the individual words on a page. Then, they zoom out a little to see chart patterns, which are like the sentences and paragraphs. And finally, they use really broad indicators, like moving averages, to get the overall theme of the story. Let's take a quick look at an example of each.
So this little thing here is called a doji candle. Think of it as a literal tug of war. For one whole trading day, the bulls tried to push the price up and the bears tried to slam it down. But by the time the bell rang, they ended up right back where they started. It's a stalemate. Now, seeing one of these after a really long run up or a long run down can be a huge signal. It tells you the side that was in control is getting tired, they're losing steam, and a change in direction could be coming. It's a moment of pure, raw indecision.
All right, so if a doji is like a single word telling us about one day's battle, what happens when we string those words together? Well, we start to get sentences, or in our world, chart patterns. This, for example, is what's called a textbook bull flag, and it's just a classic sign of strength. You get this powerful, explosive move up, that's the pull, and then instead of collapsing, the price just kind of rests. It drifts sideways or a little bit down, that's the flag. It's like the market is just taking a quick breath before its next sprint higher.
And finally, let's zoom all the way out to the big picture. This quote really gets to a major rule of thumb for so many professional investors. The 200-day simple moving average is nothing complicated. It's just the average price over the last 200 days. But it acts as this huge long-term trend indicator. For a lot of people, it's the line in the sand. If the market is trading above it, things are healthy. The long-term trend is up. But if it falls below, that's a major red flag. It suggests a real shift into a more dangerous, bearish environment.
Okay, so all these charts and patterns, the technicals, they tell us what is happening. But that's only half the story, right? To understand why it's happening, we've got to look under the hood at the real engine of the economy. We need to talk about the fundamentals.
Think of these as the main gauges on the economy's dashboard. The Federal Reserve's interest rate policy is massive. Lower rates, it's like hitting the gas, making it cheaper for businesses and people to borrow and spend. GDP, that's the total value of everything a country makes. Is it growing? Awesome. The economy is expanding. Strong jobs reports mean people have money in their pockets to spend. And the CPI, that's our main measure for inflation. All of these data points are the actual fuel for long-term bull and bear markets. But sometimes, the whole engine can seize up. That's what we call systemic risk. The 2008 financial crisis is the poster child for this. It wasn't just one bad company or one bad sector. It was a fundamental crack in the entire housing and lending system that spread like a virus. When millions of loans were given to people who could never pay them back, it created a massive bubble. And when that bubble finally popped, it didn't just take down a few banks. It triggered a devastating, global bear market that affected almost everybody.
Now here is a really key insight. The market isn't just one big thing that moves in perfect lockstep. It's really a market of markets. Even when we're in a roaring bull market, some parts of it might be struggling. And even in the depths of a bear market, some areas might actually be doing great. This is where understanding cycles in different sectors becomes a huge advantage. You see, the economy isn't static. It moves in cycles, from recession to recovery and then back again. And the really smart money doesn't just react to the headlines, it anticipates these shifts. So as the economy starts to move from one phase to the next, you'll see big money flowing out of the sectors that are about to get weaker and into the sectors that are expected to get stronger. It's this constant forward-looking rotation that savvy investors are always watching. And you can basically break this down into two big categories. When the economy is strong, people feel good, it's a bull market, they spend money on things they want. That new iPhone, a vacation, a new car. That's when these aggressive sectors like technology and consumer discretionary do really well. But when the economy looks weak, people are worried, maybe a bear market is starting, they only spend money on things they absolutely need. And that's when defensive sectors, think consumer staples like toothpaste and food or utilities and healthcare, tend to hold up much, much better. And on top of all that, this is pretty wild. There are also historical seasons in the market. Now let's be super clear. This is not a crystal ball. It's just a tendency that has shown up over decades of data. This chart shows a couple of examples. April, for whatever reason, has historically been a really strong month. Some people think it's because people are investing their tax refunds or annual bonuses. On the other hand, September has often been the weakest month of the year. Again, it's not a guarantee, but it's another layer of context that professionals pay attention to.
So we've talked about the what, the why, and the where. Now we get to the most important part of all. What on earth do you do with all of this? How do you actually adapt your strategy to the trend you think is happening?
You know, the single biggest trap anyone can fall into is developing a fixed mindset. You know these people. There's the perma-bull who thinks every single dip is a screaming buy, even when everything is pointing down. And then there's the perma-bear who's been calling for a market crash every year since 1995. Both are incredibly dangerous because they let their opinion blind them to what the market is actually doing. The goal is never to be bullish or bearish. The goal is to be right.
So here is a really powerful mental exercise you can use to stay objective. Play devil's advocate with yourself. Before you make up your mind, force yourself to build the strongest possible argument for both sides. Literally, write it down. The bullish case is, and list all the evidence. Then the bearish case is, and list all that evidence. By doing this, you're challenging your own biases head-on, and you can let the weight of the evidence, not your gut feeling, guide your strategy. Okay, let's bring all this home with a simple piece of wisdom that has been passed down on trading floors for more than 100 years. It's simple, but it is so profoundly important.
So I'll ask you directly, right now, based on everything we've talked about, the charts, the economy, the cycles, where do you stand? What's your bias? Are you feeling more like a bull or more like a bear?
But you probably saw this coming. That was a bit of a trick question. Because the real goal isn't to pick a team and root for them no matter what. It's to be more like a surfer. A good surfer doesn't argue with the ocean. They don't try to force the wave to go their way. They study the waves, they understand the current, and then they ride the wave that's there. The only thing that matters is understanding the reality of the market and aligning with it. Being in harmony with the trend.
And to wrap it all up, this quote from the legendary trader Jesse Livermore says it all. The tape, he says, today we just call that the price action on the chart, that's the final judge.
You can have the most brilliant, well-reasoned opinion in the world, but if the market is moving against you, your opinion is worthless. Markets are never wrong. Opinions often are. And the most successful investors are simply the ones who learn to listen.